Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at Dryer and Cash Flow Forecasting Software, where we help the office of the CFO leave spreadsheets behind, delivering clear and accurate forecasts to the management team. And joining me today is Greg McDonough of Blackburn Capital Advisors. They provide financial coaching for business owners, equipping them to make informed financial decisions. And today, we're going to explore the importance of clean and consistent data to eliminate guesswork, remove stress, and drive better business decisions. Thanks for joining me, Greg.
Blaine, it's a pleasure.
And so, before we hop in the show, we were actually started to dive into the importance of data. And I thought, we got to better record this because we'll talk about it all day. But you were talking about let's start at the very beginning, how important having those data sets clean and clear, as a foundation for your business. Why is that so important?
Well, Blaine, I'll answer that question slightly different than you asked. When I engage with a client, usually the first thing I'm asked is, hey, I did so well for this year or this performance period, but where's the money go? Where's the cash? Where's the actual output from the performance of this financial statement? And then we end up spending a lot of time in balance sheet accounts, in income state accounting, and really digesting sort of what's the difference between the gut feeling that they have at a performance period and what the financial statements are saying. And what it boils down to is data, right? Is your financial statements giving you a true reflection of what the business is doing over a particular period of time? So that's what I mean when I'm talking about the cleanliness of the data, the timeliness of your data. I find a lot of entrepreneurs, a lot of business owners who make their business decisions a lot, and I do the same, right? A lot of it's gut feel. It's like, maybe I'm right, maybe I'm wrong, let's just go for it. But I find that the stronger your data is, the stronger your dashboards are, the stronger and more current your financials are, the more reliant you can be on those, which then gives you the confidence that your decision-making is at least based on good data, right? There's always the economy that could shift, or the customer is going to change their mind. That's going to impact and elevate the risk in your business. But at the end of the day, if you can eliminate this one worry, it's just a much simpler approach for the business owner.
And I'm curious if it's like, we see this all the time with people coming and talking with us. It's like, they'll come in and sometimes go, okay, yeah, this account is just a mess. But I look at it and go okay, it's such a mess, but somehow it seems to be adequate to do the financial statements, is probably accurate as a reporting tool for the government, does not work for the business. Where's the breaking point there? What is the difference between those two? Or is it that there actually is it's a messy data and it's going to be messy from end to end?
Well, it's a little bit of both. And right, the messiness tends to accumulate over time, right? Which is one of the beauties of the balance sheet, right? This could be a problem or a messiness that has been inherent in the company for 10 years. And if you get audited financials and it's immaterial, your auditor's not going to pick it up. They're not going to test it. They're not going to figure it out. But it could very easily answer the question from a business perspective of, hey, I thought I did X and really the outcome's Y. It could be built into whatever process you have in recording those transactions within those accounts. Or maybe there's just a habit within the organization of sort of being okay with sloppy data, sloppy information, happy with 70%. If you're a C student, go for it. But in my experience, that unpacking those and sort of rectifying those issues also leads into other indications and other challenges within the business, just within their processes.
And I go back to the day when we used to give our bookkeeper a big box of papers at the end of the month, and we would meet with our accountant quarterly, and that was, at that time, didn't seem to be much help. And the only thing that seemed to matter to us were the spreadsheets we had inside the business that gave us optics looking forward, that seemed to have a completely different data set than what we would hand over in this giant shoebox, right? It feels like some of the, mindset hasn't changed, even though the technology has changed, right? And I'm just sort of curious, like I get it with business owners, like number one is, we want to grow our business. And um, how do you talk to business owners where you can explain this to them and they can kind of go, oh yeah, it's important. How do you actually you get that message across or convince them that this actually is really important? This is going to transform how you run your business.
Blaine, that's a great question. What I'm finding to be successful into making that connection is connecting their financial management habits to their purpose, right? So if I know that I love to challenge the status quo and I'm looking for a better way to do whatever I'm trying to accomplish, if I can tie those core values, my purpose, my why, to the financial management habits, which ultimately gives me my financial results that I want. If I can make that connection with the companies that I work with, it becomes a lot more open to understanding. It's kind of like going to the gym, right? If I've got a race on my calendar, if I'm doing a half marathon in 6 months, I'm much more likely to go to the gym tomorrow than if it's just no deadline, no goal, no. So I find that if I could bring together their purpose, their core values, and bring that into the conversation around their financials and their financial habits, that the clarity starts to bubble up and they start actually doing the things I ask them to do.
So where are some of the actual friction points? Like what are some of the problems that you tend to see over and over again that are like, okay, this is just maybe, or maybe there isn't, but is there a chronic issue that you see quite often that's like, that's kind of the leading pointy end of the spear? This is what's making your data pretty unusable.
Yeah, and it varies across sort of the entrepreneur versus the solopreneur versus the small business owner versus the nonprofit versus a medium-sized business. Um, but I tend to find that most of them are sort of cash account managing their business by what cash is in the account, right? So they open up the bank account and there's $100,000 and they say, "Hey, I'm rich. I can buy whatever I need to. I can make payroll next week." But they've kind of forgotten about the liabilities and they've forgotten about the assets they've invested in. They've forgotten about the other things that have been recorded and bookkept correctly, but they're not seeing that in the moment, right? And so that's one example. Another example is if they're taking distributions sort of below net income and they're looking at their income statement without taking into consideration their distribution and really looking at a retained earnings sort of model, that's giving them a different perspective of the health of the business. So like, you're making X, you're putting $50,000 on the bottom line, but you're taking 75,000 in distribution. Well, you're digging a hole, but you're not going to learn that by just looking at your income statement. And so it's those types of things and it varies really between size and industry and just the personality of the entrepreneur. But yeah, those are a few examples.
Yeah. So if a client came to you and said, okay, we just seem to have this issue where we really don't know where we're headed, or maybe like you've already explained, like my financials don't seem to always match up with what I think's happening in the business or the money we have at the end of the day. Where do you start? Like, where do you say, all right, let's get going. Here's where we start unpacking this.
So for me, I start with cash flow, right? Because cash tends to be king. And it's not just for the historical perspective, like, hey, where did you think you were going to be versus where you are, but also from a forecasting. And so one of the exercises we would go through is, setting up a 13-week cash flow forecast. And then every couple of weeks we measure where we are. And if we start seeing where we're off from a cash flow perspective, well, maybe we're assuming too much revenue that turns into cash, or the AR is aging a little bit slower than we expected it to. And those types of things that influence our reality versus our gut feel tend to come through. And then the second to that you really go through the balance sheet and you say, all right, let's reconcile this prepayment account. What, similar to if you're going through an audit, right? It's what are the 10 items in here and are they really relevant to the business anymore? Or is this fixed asset still in the building? Or is this AR really collectible? And you really start sort of, cleaning up each of those accounts. And then again, you find history worth of AR, for example, that is 90, 180, 360 days old. And it's like, all right, come on. This is really just lost revenue. Let's write down revenue. to make the story sort of match what reality is.
Yeah, and I imagine that's like a bit like before Dry Run, I had a professional like creative agency for over a decade, and we were just ARAB. Timing was always like on the big issue for us. But then I know like I've had friends that have inventory driven businesses, and it's like usually there's inventory sitting on the shelf they don't know about, and so it's almost like there's different models of business, but each one of them seems to have some not dirty little secret, but some hidden corner. Like there's a problem that always seems to be a bit of that issue that's easy to overlook. How much friction do you see when you're like talking with business owners? I know it's different from each to each, but do you see by and large they're like, yeah, I got to get hold of this, or it's just like I just want to get back to work? Like, what's your sense on that?
Yeah, they mostly want to get back to work, right? They probably recognize that there's an issue there. They don't like the fact that the results don't match what they feel, but it's probably close enough that they get through it, right? They got things that they are great at, and they got, just like all of us, and we've got things that we're not so great at. And so they were going to concentrate on what they're great at and let the other pieces sort of, go to the wayside. The trick for me is building the team, either through employees or contractors or professional services, but building a team that could fill those blind spots. And me to say, hey, Blaine, you know what? We haven't really paid attention to this recently. Can we spend, I've done some analysis, and can we spend 10 minutes just talking through what I'm seeing versus you having to like pull out your spreadsheets, pull up your QuickBooks file and actually do the analysis yourself. And so, right, recognizing the fact that it is there and then worrying about, hey, this could build into something bigger. Maybe I should take an initiative and unpack it or figure it out. But at the end of the day, the reason why it mostly builds is because these businesses are growing so fast and it's not a priority. And I get it, right? Mm-hmm. Customer sales, revenue. But if you don't sort of build a good process internally, you're going to be scaling probably at an unprofitable rate. And when the economy shifts or customers change their mind or your product does something, you're going to be not like that inertia, that momentum is going to go away, and you're going to realize all these things are really problems versus solutions.
And the things that like make my ears perk up as soon as you say it, like economy shifting and customers changing mind, and it's like, yeah, that's been probably the last 2 or 3 years more than, and 25 doesn't look like it's going to be a whole lot different. Like it's going to be a little bit potentially a little bumpy. How much of I don't know how much, but like with these customers, how much do you think is really like the process that they have in place versus like how much can be answered by process and how much actually has to be technology? Like you're actually going, okay, you guys are still on the, sending an invoice on the back of a napkin here. Like, how do we get you moving here? What do you sort of see from that? Is it a lot of technology, or and then how do you actually convince them to move forward with technology?
Well, I think it starts with process, right? I think it starts with figuring out how to get from A to B to C to D to E with respect to your financials and your cash flow and your reporting. And once you understand that, then you could implement tools, right? You can implement tools like Dry Run, where, hey, for a click of the button, you can see your forecast for the next 13 weeks. You can read your 13 weeks in the past. But if you haven't done the work to understand exactly how the data is coming through and where the balances end up, and if there's discrepancies, where those discrepancies, if you haven't done that work and built out that process to make sure that it works historically, then you're going forward is going to be as good as what it's going to be, right? It's going to be based on averages. But you could be much better if you've sorted out that process or corrected that process or even put one in so that the historicals actually look and the results actually match what your statements are saying and what your gut's saying, what the bank's saying.
It's when you talk about this, I think back to my agency days, and I sort of mentioned we were still in a bit of the shoebox method at that time and everything. And I can still remember, sitting in my accountant's office and him going through our financial statements. And by then it's like, well, it's the end of the quarter and it's a month past the end of the quarter. And it's already like, it always felt like ancient history to me. Right. And And I remember in my mind just being that business owner, especially at that time, I was just kind of like, I would nod, but in my head, I'm like, I know I was there. And then on the other side, I'm like, I don't know why this matters and I don't care. Like, never saying that, just nodding and smiling, but always like, I got to get back to what I saw as reality. And that's, like you said, with business owners, it's like, even back in those days for me, it was like, we just got to drive revenue. We just got to, we got to find that next client. If we don't have the next client, we don't have revenue. And it's, the priorities are there. It's a mindset of an entrepreneur, so much of it, right? And it's I wanted to dig into that a little bit of what are some of the effective ways you found to actually address that mindset and get them excited about and kind of a long-term engagement, change in mindset, not just like they appreciate what they see once kind of thing.
Yeah, I mean, it's a process, right? Like everything else. And I'm not sure they ever truly appreciate it as much as I do. But it takes time, right? I mean, I have worked with clients for multiple years that at the beginning, I would say, hey, we want to set up this, very much a profit first sort of methodology, put certain cash balances in certain cash accounts because for the rainy day and for the tax and whatever else. And they don't really understand why it makes sense or how it's safeguarding them until they get 12 months later and it's tax time and they owe the IRS $50,000 and they got $60,000 in the account. And now it's like, hey, look, it worked. Right. And so, it's just a relationship thing. It's trust, it's process, it's 1 month at a time. Some clients lose interest and sort of go on their way or get back to their old habits, and some lean in. And, once the magic starts happening, you really see it. But it's tough. I mean, I'm an entrepreneur as well. And so and I've run my prior businesses, and, my shoebox method, Blaine, was, you had all the bills in the shoebox and you had how much cash you had. And once you just pick out the 10 that you can pay and you pay them and you leave the rest in the shoebox. Those were not fun times. And it's one of the reasons I'm passionate about sort of real-time data and real-time cash positions and understanding like what's the next 13 weeks look like? What's the next 90 days look like? And then measuring against that performance. And so don't just set a goal and then get to the 90 days and not look back and say, oh, I thought I was going to be at X and I'm really at Y. Like why it's so different.
Yeah. And it feels like the things have changed so much over the last like 3-4 years, even like, they're for 1,000 different reasons. But it feels like there's never been a time it's more critical for businesses to be able to look forward and try and understand this potential upcoming volatility, potential opportunity, but then the risks. Like things always seemed kind of lumpy and a bit chaotic, even back like 2008, 2009. Like and compared to now, it almost feels like nostalgic for it because it just seems. Yeah. Because back then it was like, yeah, there's things in the economy and everything, but now it's a mix of economy, but also technology and all of these things all mixed together. I can imagine it's just a overwhelming time for business owners, just to have so much involved.
Yeah.
And how do you, I guess, sort of reassure them and bring them back to some sort of reality to I don't know, simplify things and bring them back to ground them?
Yeah, there's a couple things to answer that question. And the number one that comes to mind, and it's my core principle when dealing with businesses, is having cash reserves, right? So, and this takes time to build. If you're at a zero cash reserve or even in a negative position in your business, we've all been there. Don't be ashamed. But if you over time have been able to save up 3, 4, 6 months worth of operating expenses in your business, when these chaotic times happens, when the pandemic kicks in, you're not that fearful, right? My clients that had strong cash balances going into the pandemic, they excelled. It was a great time for us. It was the ones that have been living sort of on edge and in like a not stable foundation in their business that it's like, oh, is this the straw that breaks the camel's back? And then that just, snowballs and snowballs and snowballs. So granted, it takes time, right? It takes time to build that cash reserve. And if you're not doing it now, you should be looking at it and trying to build, because the economy is going to turn at some point again. Customers shift, their interests change. So for me, again, to answer your question, like building that cash reserve and having the discipline to do it is sort of number one, hedge against the economic turns.
So, how this is really has been really interesting. How should people get hold of you? How do they track you down? Where should they be, finding out about you, and who should be talking with you?
Yeah, absolutely. So my website's blackburncap.com. You can find me on LinkedIn, Gregory McDonough. There's lots of ways if you just Google me or look at Blackburn. Also got my own podcast in the endurance space called The Chief Endurance Officer. If you like talking about Ironman racing and endurance racing, it's the other side of my life. But yeah, people that should come to talk to me are those that, again, look at their financials or look at their data, and it just doesn't match their gut feeling or where they think they should be. Or, again, a classic example would be you get to the end of the year and you've got all this profit, you look at the bank and it's gone and you don't know why. Well, let me help you sort of navigate that. So I spend a lot of my time coaching clients under that umbrella. I also do, fractional CFO work where I roll up the sleeves and take on that CFO role for a 2, 3, 4 month period, either to improve an organization's finance and accounting group, send it out to an outsourced provider, or if you just want to replace some people or turn, a lot of the organizations I've worked with have been around for 20, 30 years, and it's the same two people sort of in the finance seat and accounting seat. And to your point about technology, they're just super behind the times. But as an executive director or CEO, it's tough to make those changes, because who's going to make payroll next week? Who's going to run payroll next week? Who's going to pay the bills? And I've figured out a process to sort of jump in and help in those situations.
Yeah. Well, thanks so much, Greg. This is a really great conversation, really interesting. And I encourage you all to look up Greg, especially. It is a bit of a volatile time right now, and Greg can help you through that. And especially even if it's a short-term engagement, get you on track and back into the mix. And if you're looking for a way to forecast your cash flow, understand where you're headed as a business, or whether you're a CFO and you're helping numerous customers, come and talk with us at dryrun.com. We're going to help you just take control of that cash flow, get you out of a spreadsheet, save you some time, and give you something that you can use to explain things to the management team and make sure everyone's on the same page. Thanks again, Greg. I really appreciate it.
It was my pleasure, Blaine.